Right now, thousands of homeowners across the country have VA loans with interest rates in the 2s and even 3s. Many of those loans can be assumed. That means a buyer can take over the seller's existing VA mortgage, including the remaining balance, the low interest rate, and the exact monthly payment. If you're a veteran, active duty service member, Guard, Reserve, this is one of the strongest strategies available in today's market. And in this video, I'm going to break it all down. What a VA loan assumption is, who can assume a VA loan, how qualification works, how entitlement is protected, how to calculate the seller's equity, how to use a PiggyBack second lien, and step-by-step assumption timeline, risks, benefits, and common mistakes, and exactly when a VA assumption makes sense. And by the end of this video, you'll understand everything you need to know about using VA assumptions as a buyer, seller, or a real estate agent. Hi, I'm Alex Ramirez, and I help military families, veterans, and home buyers understand and maximize their VA loan benefit. And if you want clear VA content that respects your time, hit that like, subscribe, and tap that bell so you don't miss any of my videos in the future. I do weekly updates. Now let's get into it. So what is a VA loan assumption? A VA loan assumption is when a buyer takes over the seller's existing VA home mortgage. The buyer assumes the existing loan balance, interest rate, monthly payment, remaining term, and escrow setup. And it's not a refinance, it's not a new loan, it is the same mortgage transferred to a new qualified buyer. An assumption is never automatic. The loan servicer must fully approve the buyer before it can even happen. And why is this so powerful? Most sellers who bought in 2020, 2021, or early 2022 locked in an interest rate between 2.25 and 3.75. Those rates are not available today, and assuming them can reduce a buyer's monthly payment by hundreds or even thousands of dollars. For example, a payment at today's market rate might be around $3,200 per month, while the assumed VA payment could be closer to $2,100 a month. That's roughly $1,100 in monthly savings, which is why assumptions are getting so much attention. So who can assume a VA loan? There are 3 common assumption scenarios for this. So first, a veteran or eligible military buyer can assume the loan and substitute their entitlement. This fully restores the seller's entitlement so they can use the VA loan again. Second, a civilian buyer can assume the loan if they qualify financially. In this case, the seller's entitlement remains tied to the property, which may limit their ability to purchase again with zero down. In some cases, all the entitlement can be gone, or they'll have partial entitlement left, so it's really going to limit what the veteran can purchase. Third, a surviving spouse with VA eligibility may also assume the loan and restore entitlement. Any qualified buyer can assume a VA loan. The key difference is how the seller's entitlement is handled. So let's go over qualification for a VA loan assumption. Even though this is an assumption, the buyer must still qualify for the existing VA loan through the current loan servicer. Here's what the servicer reviews: income and employment, residual income, debt obligations, credit history, and overall ability to repay. Compliance with VA underwriting standards as well. The servicer is responsible for processing the package, approving the buyer, and issuing legal assumption documents, and releasing the seller from liability when applicable. And because every assumption goes through the current servicer, timelines can range from about 30 days to several months, and depending on the process. Typically, there is no new appraisal required, but a full credit and income review is standard. Let's go over the biggest challenge. It's covering the seller's equity assumptions transfer the existing loan balance, not the seller's equity. So for example, let's say the home value is $500,000 and the remaining VA loan balance is $350,000 on the loan, and the equity gap is $150,000. The buyer must cover that equity in one of 3 ways: pay the difference in cash, negotiate a lower equity amount with the seller, or use a PiggyBack second mortgage to finance that part of the gap. The third option is what makes many assumptions possible for today's buyers. So let's go over the PiggyBack second lien option. Some lenders allow a second mortgage behind the existing VA loan to help cover the seller's equity. To structure this, the buyer must typically bring in at least 10% of the purchase price as a down payment, qualify for both loans, and work with the lenders and servicers that allow subordinate financing. And when done correctly, the blended payment from a low-rate VA first mortgage and a higher-rate second mortgage is often still far lower than buying the same home with today's full-rate financing. And here are some important considerations. Not all lenders allow second liens. Not all servicers approve assumptions with piggybacks, and buyers must qualify for both payments. And the second lien must remain subordinate to the VA loan. And when structured properly, this strategy turns many assumptions from unrealistic to achievable. And if you want help calculating the equity gap, exploring a piggyback option, or confirming which servicer rules apply to your situation, reach out to me. My number is going to be right here on the screen, 805-857-3708, or you can go to the description below and schedule a call with me through my Calendly. And let's go over how entitlement works in a VA assumption. Entitlement determines whether the seller can reuse their VA benefit after their assumption. If the buyer is a veteran using their own entitlement, the seller's entitlement is restored and they can purchase again using VA financing. And if the buyer is a civilian without VA eligibility, the seller's entitlement remains tied to the property, which may reduce or eliminate their ability to buy again with zero down. Understanding this difference is critical before agreeing to an assumption. So make sure you talk to a professional before you agree to this process. And let's go over release of liability with the seller. So to protect the seller from when the assumption closes, the seller should receive an official release of liability from the servicer. And without that release, the seller could still be legally responsible for the loan if the new buyer stops making payments in the future. And this is why confirming the release of liability is one of the most important steps in the entire assumption process. So how do payments, taxes, and escrows transfer? So after closing, the buyer takes over the exact principal and interest payment, interest rate, remaining term, property taxes, insurance, escrow structure, and HOA obligations if applicable. And if the seller is 4 years into a 30-year loan, the buyer continues from that year 4. And the payment rate and timeline do not reset. This is one of the main reasons VA assumptions are so valuable in a higher rate market. And let's cover the typical costs and fees for an assumption. Many buyers and sellers ask what an assumption actually costs. A lot of people have this question. So VA rules limit the servicer's processing fee, which is commonly a few hundred to about $1,000. But always make sure with the servicer to verify this information. There may also be normal closing costs related on the transaction, like title, recording fees, and it's all depending on the location as well. And even with these costs, the long-term payment savings from assuming a low interest rate are often dramatically larger than the upfront fees. So the step-by-step VA assumption process. Okay, so step 1. Seller confirms the loan is assumable with the servicer. Step 2, buyer submits financial documentation to the servicer. Step 3, the servicer reviews credit, income, debt, and residual income. Step number 4, buyer and seller agree on equity. And step 5, buyer verifies funds or secures piggyback financing. And step 6, servicer issues conditional loan approval. And step 7, buyer signs final assumption documents. And step 8, payment responsibility transfers. And step 9, seller receives release of liability and possible entitlement restoration. And with this process, timelines vary based on the servicer, typically ranging from about 30 to 120 days. And if you want expert help structuring a VA assumption, analyzing payments, or determining if a piggyback second is an option, reach out to me directly. You can go to my description right below and schedule a call with me. I'll walk you through the entire strategy step by step. So the benefits: major monthly payment savings, no new VA funding fee, and often no appraisal required, and potentially lower total ownership costs, and access to interest rates no longer available. And the risks and challenges, let's cover that. Large equity gaps, slow approval timelines, seller entitlement remaining tied to the home, higher rates on second liens, and servicer-specific restrictions. An assumption may not make sense if the seller's equity is too high, the servicer's timeline does not match the contract, or the buyer plans to move again in a short period of time. Assumptions make the most sense when the seller has a very low interest rate, the buyer has some available cash, qualification for piggyback is possible, and the buyer plans to stay in the home for long term. So VA assumptions are one of the most overlooked but most powerful tools in today's real estate market. And if you want help analyzing an assumption, calculating the blended payment, or structuring a piggyback second, reach out to me directly and send this to a veteran or active service member. This might help. And don't forget to hit that like, subscribe, and tap that bell so you don't miss any of my videos in the future. And remember, be smart, be prepared, and let's get you home.